through industry sector, through region, through operating model, and our latest report's just been released. But over the last 10 years, we have seen tremendous advances in CVC professionalism and have been absolutely delighted to collaborate with Jody in defining the standard CVC team roles and in really developing the first and the deepest set of CVC compensation benchmarks. So thank you for having me.
Great. And then Jim, why don't you fill us in? You're sort of the third leg here, because while I have the comp data and Liz understands the consulting, there is a whole legalese around how CVCs are set up and their, how they work with the parent company. And that really is the legal component of all of this.
Yeah, happy to. So hello, Jim Fisher. I'm a corporate partner in DLA Short Hills office in New Jersey. I'm one of the leaders of our CVC practice. It's a pleasure to be with you here today. We have been with the J.Thelander Group for many years now. This is my first experience doing this. I'm excited to be here today, and we look forward to your questions and being as helpful as we can be.
Great. All right, I'm going to jump in. And for those of you, because I see the numbers have changed again, J.Thelander, we are here to discuss. We pulled this data in the beginning of March or the middle of March. So the nice thing about the J.Thelander platform is that I'm going to keep moving now as the slides, that our compensation surveys are now open year round with weekly updates available on the platform. And all participants in surveys get access to a subset of the results for no charge, which is really great. And then we also, all this data is pulled from full access. But the nice thing is that it's real time. There's no delay at all. So like as I said, Liz just gave us some content for questions, and I guarantee you by tomorrow, those questions will be in the survey and we'll be able to include that in our on our platform. We've been doing this for 25 years in a combination of, here's a list of all of our, let's see what's going on here. We have a list of compensation surveys for. The other nice part about this is we cover the whole ecosystem. So we cover investment firms, so venture, private equity, and corporate venture. And it really allows us the ability, and you the ability, to compare and contrast. And then the third piece of this is the private company compensation. So we truly understand the ecosystem, what's going on with both the portfolio companies and the base pay, bonuses, and equity, in addition to the cash and carry, and then carry dollars at work, and the shadow phantom carry. There are a lot of different moving parts here. So we have Morgan on my team who is monitoring the chat, and it would be great if you could give us questions. Let us know if you want us to delve into something a little bit more, or to move a little more quickly into another area. We've got an abundance of data and information here, which we are definitely not going to get through it all, but we have the opportunity to pivot because of Liz and Jim's expertise. We don't really have a canned speech here for you all today. We're really looking for this to be interactive. So keep your questions coming. Here is a list of, I find this to be amazing, of investment firm and CVC positions. And you can see on the corporate venture side, Liz, I think we started out with 3 or 4 positions back in the day. And now we've really grown. Some of the areas that have grown most of all have been like the CV business development, CVBD roles, and also the VP of Innovation, Head of Innovation. I think what Liz has said, and what we've really been able to be privileged to participate in, is creating a real profile and a real, what's the right word here, job track, a career track for CVCs. And it's become now a very formal structure. There are, even in the venture world, and there are now having, career progression and salaries and bonuses and things that are being measured and able to really create an infrastructure, because most of these jobs and what the CVCs have been able to do, which now the venture firms are learning from, is have real end-to-end solutions for the portfolio companies. So Liz, I know you want to touch on that for a minute, because you really helped me learn and understand that that's what the CVCs do better than anybody.
Yeah, it's really the C in CVC, the ability to deliver not only the resources of the parent, but also to ultimately add to and enhance the value and the long-term exit potential for the startup company. And I think CVCs have done an amazing job at kind of blending professional investment team and professional business or portfolio development teams, kind of the CVC equivalent of the VC platform teams. And I think that's what's really enabled them to establish positions of influence and respect in the industry.
Yeah, absolutely. And Jim, do you have a position on this as well, like seeing your clients really adding these new roles and understanding? Because some of the CVC people are involved also in the parent company. They have a dual role, and they also, have a role within the CVC.
Yeah, very much so. So we're seeing, as you are, a very active and vibrant sort of undertaking in terms of how people are creating titles, what those titles equate to. Is there an equivalent title at the parent company that they're trying to benchmark against, those types of things? And absolutely, we're seeing senior leadership in many cases with respect to the CVC fund hold high level positions within the parent company, and often liaising with either the corporate dev groups or the chief strategy officers, things of that sort, to make sure that goals are aligned. Frankly, people are doing things in a way that doesn't sort of overlap, if that is an issue for folks. So we're certainly seeing an expansion, and I would say it's at all levels. It's not only at the higher levels, but at the lower levels too, in terms of analysts and junior analysts and things of those sorts.
Yeah, we see this on the compensation side. It's not always cut and dry the comp for a role, because they could be getting compensated for a dual role. So let's delve into that. I know everybody wants to see comp numbers and understand the data. So this has been an ongoing question of where is your CVC unit headquartered? And so the US is still 74%, but you can see Europe and other countries obviously are on the rise. And it doesn't, and there may be different comp structures depending on where folks are located. It's just because they are headquartered one place doesn't mean there aren't offices in other locations. So here is within the United States, very well covered throughout the country. Obviously, this is very much tied to where where the parent company is. And even we see this on the investment firm side. It is by no means, we're going to try and stay away from that subject of Silicon Valley right now, just in what's the changes and the shifting of the infrastructure. But it definitely has become more of across the country. It is not only just the Bay Area located anymore for even VCs, and the CVCs very much reflect that. And then within Europe, we can, and again, we're now trying to capture if you do have multiple structures for your folks from the United States and Europe, that we capture all that to present a bigger picture of what the European market looks like. We're able to do that for VC as well, because we've had a couple of projects where we pulled that data. This is, I think the crux of it is like, from what types of organizations were your CV unit business or portfolio developed team recruited? This is just a bellwether for what's going on, is that you can see that there's a lot of growth coming from the parent. And Liz, maybe you want to talk to this, because I know this question came from you as well.
Yeah, no, I think it's been our experience that typically the business or CVBD or portfolio development team, 2/3 often come from the parent, from roles like strategy or corp dev or finance or BD, whereas on the investment side, it's the opposite, with 2/3 coming from the outside, from CVCs and PE. And
yeah, here's the new hires coming from. This is what I wanted to show you, is that this is exactly what you're saying. So I think it's important to understand that there's a hybrid, and there's a hybrid of mentality. And I mean, Jim, I'm sure you see this, right? When you're working with clients, we have to somehow maneuver between the VC mentality and the parent company mentality.
Yeah, no question. And it certainly evolved. I mean, when I first started doing this probably 10, 15 years ago, I don't know that those numbers would be the same, right? I mean, I think it certainly evolved to the point where you're seeing more of an interaction. I think the CVCs have, or the parent companies, I should say, have become more comfortable bringing in people from the outside, when in the beginning, at least when I first started working with them, there was a little bit of a reluctance. It was a little bit of a tension there. I think that for the most part has I wouldn't say gone away, but certainly has improved, and you're seeing that external influence be quite significant in many.
Yeah, and we see it in the compensation, because I think it used to be sort of we would have to remind people going to CVC and even in venture that the carried interest was not free flowing all the time to everybody every day, and not everybody was making tens of millions or $1 billion a year. And I think now there's no question that that is true. The markets have dictated, and we see this very much without anybody's needing an education on it. So the CVC consistent model of corporate stock or shadow phantom carry and the different levers that we're going to get into were always attractive, but they weren't as attractive at such a clear level. And I mean, we know now that there is more cash consistency at CVCs, and that the VC liquidity is, the vesting times that are taking longer on the VC side. We've seen an influx of vesting moving to 10 years plus. So there are merits to both, and there are career tracks to both. And you can also move from one to the other. And there is no doubt. You're both shaking your head, right? I mean, this is what we're seeing, is there's much more fluid moving within the parent company, moving from VC to CVC, and moving into the portfolio companies. The whole ecosystem has become much more fluid. So let's look at the comp structure, because at the CVC unit structure, because we have come to understand, and Liz and Jim would very much like your input on this, that this does impact compensation. So Liz, I'll let you describe from here. I have this slide on annual amount of corporate allocation, venture, and total corporate venture capital under management, who came from the parent company, and the structure. So let's start with the first one, the annual amount of corporate allocation. So this would be for a type of firm, CVC, that is structured this way, right? The separate entity, either with an investing fund or annual investment fund.
You're an evergreen of some sort.
Yeah.
Yeah, I mean, I think certainly you do see that that the assets that typically, as the assets under management grow, then often you see the CVC firms evolving to have a greater level of kind of operating autonomy and a greater emphasis on financial returns, which does impact obviously compensation when it's performance based. But the mandate for delivering strategic impact never goes away. So no matter how financially oriented or independent these are, all CVCs are strategic. So the compensation needs to reflect a combination of delivering on the strategic mandate as well as delivering financial performance.
Yeah, Jim, can you expound upon that a little bit?
Yeah, I would say two things. One, from a legal perspective, anybody that's getting involved with the CVC, if they are at the stage of forming the fund, that's a critical question: is what are my goals and what are my benchmarks? And if the benchmark is mostly strategic, you need to think about that as you're thinking about your comp, versus, because you may not be able to control what that strategic goal is over time, and it's going to evolve over time, as opposed to financial return, which is basically what they've hired you to do, right? That's certainly within your control in terms of the investment decisions you're making. And then the other thing I would say is just in terms of, at least as we've seen, and Liz mentioned this, the autonomy. Our experience is that as the fund grows and there's success and there's a sense of understanding, that autonomy grows with that. In the beginning, especially if the CVC is brand new to a parent company and they have no real sense of it, they're a little bit more, I would say, controlling, but that wanes over time.
Yes.
And I think the success really demonstrates that.
Although
we see that in consulting projects that we have worked with clients at least 2 or 3 times when they first started the CVC unit, and they were trying to work, hand in hand, part and parcel with the corporate HR department and compensation group to come up with a comp strategy. And then they have growing pains because it's not sustainable. They can't keep working and attracting and retaining people using a corporate structure. And then they get into that growth stage where they know they have to come up with something that offers more of a long-term incentive, or some kind of tie to either the portfolio company's success, or something that will allow there to be really expert investors. And then the third iteration is, if that's successful, how to push that boundary a little bit more.
Although you do see a generation of new ones coming in that have kind of leapfrogged the old
Right.
models and are starting out in independent affiliate models with some level of carried interest and a lot more operating autonomy than you saw in the past. So it's
because they're coming in and they're not willing to have to go through that
Right.
process. They're more sophisticated, and they've either done this before, or they know someone who's done this before who said, don't go down that path, right?
Exactly.
So exactly. Okay, so I think the takeaway here is that you need to understand the structure of your investment fund, what the goal is in terms of, there's going to be some parent company responsibility for strategic. But also to understand and appreciate where this sits in terms of the parent company's priorities. Because if the parent company is not interested in any financial gain or for you to have more autonomy and independence, and there are CVCs that are structured that way, then I think it's reasonable to understand that you're only going to get so far in terms of having that shadow or phantom carry or some kind of structure that has your compensation tied to the success of the portfolio company. Okay, so things have changed a little bit. We're now, as Liz and I have said, 9th year, we now have year-over-year data. So what is the structure of your investment fund? And this is from 2020, 21, and 22. And you can see that off-balance sheet, separate legal entity, and these things have stayed relatively stable, right? There has been a little bit of an uptick in the separate entity and the off-balance or separate legal entity. And that's exactly because, most CVCs or the unit leader who want to have that independence know that the way it's structured is also part of having more independence. And so here's the total cash compensation. Total cash, there's a little asterisk here because we look at total cash as a combination of base pay and an actual bonus that was given or awarded. So it's a real number. So it's not just the projected bonus. But you can see that in general, especially for that top person, and again, this is median, that the off-balance sheet or separate entity tends to be a little higher, almost on all fronts. Okay, so this is, of course, we're just going to starting sort of higher level here. What are the other incentives in addition to base pay and cash bonus? And this is by investment capital under team management. And you can see that the carried interest or the shadow phantom carry corporate stock are the 3 different levers. And of course, everyone's always interested in the carried interest. Corporate stock tends to be more, and maybe Jim, you can speak to the difference of options, performance awards, RSUs. How do those all factor in?
Yeah, so the corporate stock piece is generally almost entirely tied to the parent's performance and how it's succeeding, et cetera. And so there's a couple things that we always talk to people about when they're thinking about comp in those circumstances. One, the strategic value of what you're bringing is obviously important, but may or may not immediately have an impact on the parent company in terms of its size and so on. So you're a little bit wed to kind of what the parent's doing. And that is a lot of the reasons why we see sort of that overlap in terms of the CVC head oftentimes having a seat at the parent company's table to make sure that there's some overhead there and some overlap in terms of consistency. But the carried interest versus the shadow phantom and the synthetic carry, those are based on one of 2 things, either the individual investment's success or the overall success of the fund. And they can be very varied and very, I would say they're contract by nature. So they can be based on a number of years. They can be based on particular types of investments. They can be based on cylinders within the fund. They're very, very malleable.
Right. So this is also, this is by the CVC. I think the thing of this here is to show you that there is no one way, right? So this is the Absolutely. Other incentives in addition to base pay by CVC unit structure versus this one. The one before this was by assets under management. And true to what Liz was saying is there's more flexibility with the less than $250 million because those earlier funds now some of them are taking sort of the bull by the horns and making sure there is a carried interest structure. And then the shadows phantom synthetic carry is leaning a little bit more towards the 250 million plus with assets under management. And also the corporate stock, is very consistent. Now this is by the CVC structure. And the off-balance sheet or separate legal entity has a higher interest of carried interest because a higher percentage of carried interest because there is more autonomy. And I think that's the main piece to take away here. The syndicate partners, as you know, typically other VC firms, other CVCs. So that's also who you're competing against. Let's get into the levers of compensation. This is sort of the crux of it, right? So you have base pay. Current bonus we track as an actual bonus. and then total cash, which can be a combination of base pay and bonus, but not, it could just be base pay if there are no bonus programs, which is why they don't add up, because it's not always the same sample size. You can't just add the 25th or the 50th or 75th percentile base plus the same in the bonus, because it's not the same sample group always. And then target bonus is what's projected. And that's typically the short-term incentive, because the target bonus is usually within 1 year. And then the other incentives, corporate stock, the shadow or phantom synthetic carry, which is, pool funded from carried interest dollars based on fund performance. There could be a hurdle rate. There could be other components here, and then carried interest, straight up carried interest. Jim, maybe you could just sort of in lay person's terms tell us the difference between shadow phantom or just the carried interest in general.
Yeah, so the carried interest is, as the words on the screen say, it's a direct ownership interest or sort of benefit from the fund itself, which is generally speaking has better tax treatment than a shadow or phantom or synthetic carry, which is in essence a pool of money, generally speaking ordinary income to those that receive it, where the dollars come in and then they're used as almost a means of providing a separate comp pool or a bonus pool, as the word suggests here. So the carried interest, generally speaking, at least from what we see, is usually at the higher levels of the CVC, those that are senior in nature, and the shadow and the phantom are generally speaking for those that are, building their careers and end up becoming as we see it.
Yeah. And the biggest difference with carried interest, just to really understand on the corporate venture side versus the venture side, right? The corporate venture side, you're not raising a fund. On the venture side, you have multiple LPs, you're raising a fund. And typically on the VC side also, you have to contribute capital for your carried interest. And most CVCs do not have that capital contribution. I know, Liz, you're more involved sometimes in the actual, we consult on the compensation, and you sort of go straight all the way up to that. But you don't typically are seeing funds where the investment professionals are contributing capital for their carry. I know it happens, we've seen it, but it's not very frequent.
Yeah, we've seen it on definitely on the ones that are spun out, that are the true GP LP structure with the parent as the anchor LP. But for even the independent affiliate ones, we for the most part have not seen the investment team being able to actually contribute capital and therefore receive access to, the tax.
Right. And that's the true, in my opinion, the divider between the risk and reward, and why the compensation has somewhat of a different structure, despite the fact that the recruiting pool is obviously very consistent. Okay, so here is I know everyone's going to want to see this. We don't distribute these slides just so everyone knows. You're welcome if you are taking a picture of this to use it as your own reference, but we do have all this copyrighted and ask you so that we don't have to chase you to please not send this or distribute it or post it online. So here's the CVC unit leader, the total cash compensation by AUM. And this is, you can see the 50th and 75th percentile. And also, we do use the max numbers very frequently. The maximum numbers are not outliers, and they are used because they represent firms, like as Liz said, who are, very much independent, and they have now are competing against VCs, and they have that level of, expertise and someone who's had a lot of experience and brings that level to the table. And also that's what the CVC unit is looking for. But you can see, go ahead, Liz.
This does not include the RSUs, though, correct?
Right. This is a combination of base pay and bonus, or just base pay, right? Great. So I'm going to move to the next slide, is senior investment professional, right? So this first slide was the CVC unit leader, the number one role. And then this is the senior investment professional by all assets under management. And you can see, so the main number to look at is the total cash. And you can see the max number. I asked my team to put this here because it's very important to understand the max number can go up to $725,000. And there's no way that this in our data, because we're very careful about the leveling. So that means the CVC unit leader is definitely over $1 million, because this 70 maximum numbers for senior investment professional is not more than the max number for the CVC unit leader. And then we did show the percentage of carried interest, even though it's not the same sample size as the people who are making total cash, but we did want you to understand that these numbers come in. And maybe Jim, you could structure this so that you could explain the typically like the 80-20 split and what these percentages are a percentage of.
Yeah, so in a traditional venture capital fund, well, traditional venture capital fund or PE fund, you have a traditional 80-20 split, meaning 20% of the GP in essence is entitled to 20% of the interest after funds have been returned. So first step is anybody that's invested in the fund gets their money back. That has to happen. After that happens, then there's this 80-20 split. And then the question becomes, of that 20%, how do you allocate that amongst your team? And these numbers, Jody, I assume that's what these numbers are.
Exactly. So these are part of what is the 100% of the pool, which is really the 20% of the 80-20 split.
Right. So that's 17% maximum. That's a pretty significant number there at the end.
Right.
And it surprises me a bit, to be honest, having just seen this slide.
Yeah, and the maximum number is not an outlier. There's data hovering. We typically have 5 data points around that. So, we are seeing this, and that's why we show it, because we want you to understand the audience to really be clear that there is no one way, right? And, all of this data is available on the J.Thelander platform, and you can customize this by job, by assets under management, by firm type. And it's a very, healthy way to look at this information, because you start to see more consistency as you get down to more junior roles. But at the top level, even on the venture side, there is a lot of nuance about how these firms are doing it, the different levers and how they interact. So that's why the platform is very helpful. So this is why we're showing you exactly what I think like this way, and the data always goes like this. So this is the senior associate median total cash CVC versus VC. And this is exactly what I was saying, is that the total cash is consistency here, because that carried interest is not a high percentage of the total compensation package for either VC or CVC or the other benefits, but it's a very competitive recruiting model. And this is where it's very important to look across the whole ecosystem. Liz, I know you're shaking your head. Tell us.
Yeah, no, this is absolutely true. I think for the roles, particularly for the roles up to principal, that there's a lot of consistency between CVC and VC. And in some cases, particularly if RSUs are involved, the CVCs can actually be better compensated. I think where you get the major differences are at the more senior levels, where also, the corporates have richer packages for executive level people too. So it's apples and oranges, but there's more commonality than there's been in the past.
Yeah, I mean, if we just think about it this way, right? The corporates have one thing that the VCs don't, which is the ability to grant those RSUs and to, sort of take corporate stock, and the VCs don't have that. So there's another lever that they can utilize.
Yeah, I want to pull up another slide. Hang on. I want to pull up the on the corporate stock. Okay, I'm going to go to I have so much data here. So, okay, perfect.
And, we've actually seen some people paying out the synthetic carry partially in RSUs too, if you're in an industry where the RSUs are particularly attractive.
Yeah, Jim, why don't you go ahead and speak to this? Tell us a little bit about this.
I would think, I'm sorry, Jordan, didn't mean to interrupt you there. I think part of that is probably driven by the treatment of that. If you can get an RSU and you can hold it, you might have better tax treatment than you would if it was a straight synthetic carry, which likely is ordinary income. So, there's, without giving tax advice here, I mean, there's definitely ways to be thinking about what you're receiving, how you're receiving it, how it figures into your overall tax planning, and also what it means to the parent company, and how it accounts for it, both from an accounting perspective and from a tax perspective, in terms of what they can do with those grants. And also, I'll just say lastly, it depends on the environment you're in. Sometimes companies will look at circumstances, and an RSU might be very attractive to somebody if they feel like there's quite a bit of upside. If for one reason they feel like the stock is a bit depressed, the RSU can be certainly a useful tool.
Yeah, well, and I think that's exactly right, is that the the CVCs, the compensation model can be richer, definitely at the associate, the more junior levels up to that mid-level. And the VC data shows this. And this, because it's more cash intense and it's coming more consistently. And I think that's very important to emphasize here, because CVCs sometimes think they're chasing that holy grail of carried interest, and what the VCs are doing. And I think it's important when you peel back a layer here to understand that there's quite a bit more going on below the surface than meets the eye in terms of everyone getting that carried interest return. So this is how our corporate, this section is on the corporate stock. And so I would think it's going to be helpful to run through this so you can see the restricted stocks. And as Jim said, there are different tax treatments as well. But this is the main difference, in my opinion. The vesting time for corporate shares is running in that 3 to 4 years. And Liz, I'm sure you see this all the time in your consulting.
Yeah. And I think this is getting shorter, whereas the carried interest vesting is actually extending.
Getting longer. The over 10 years has been the largest bucket of increase that we've seen. So, and then this is the median. So this is an add-in, and Liz, appreciate that you clarified that. And then we do have a question coming in from somebody else as well. So I'll read that in a minute. That's why I keep glancing over here, is because my team is monitoring the chat, and we want to make sure that we don't disregard your questions. But you can see here that the median cash value of the corporate share distribution and this is on this is 2021, and then 2022 is the $110,000. That's real money, and this is something that you're getting for that year. It's not guaranteed every year. And then we had a question here is, let's see, do you see differences between geographies, North America and Europe? I would say in general that we do. The data shows that the North America tends to be a little bit higher than the Europe for most positions, although I don't necessarily think that's any hard and fast rule, because it is always a competitive market for the top people. And because Europe has less of the CVCs right now, I believe that is very tentative to and subject to change quickly, because having less CVCs also means that it's harder to find good people. So it's possible that those 75th and max numbers could be used in Europe as well. Liz, do you have a thought on that?
Yeah, I think it also depends on whether you're talking about a global program, or whether you're talking about region-specific programs, because certainly for the global programs, we're seeing, increasingly quite a lot of consistency of compensation levels across the entire world, and less of a regional discount than we used to see. And if that's starting to be set as the benchmark for the region, then I think that those numbers are going to, equalize over time.
Yeah, Jim, we had a question that's probably gone to you, and I can also put my input on this from the VC side, but what happens to carried interest for people who leave?
So the carried interest oftentimes has vesting and hurdle rates, and you have to basically be there in some cases to earn it. So
be present to win, right? Like, yeah, bingo.
Exactly. So that's what's sort of interesting about those tails coming longer and longer. So the theories there have always been, well, you're trying to match the carried interest sort of vesting and be there to receive theory with when are we going to exit. And right. Those questions are difficult to answer, and have become more difficult to answer in the environment we're in. So right. You generally have to be there to get it, but there are certainly structures where it vests over time. So for example, if you have a 5-year vest and you leave after 3 years and the carry gets paid out, later on, you'd be entitled to a portion of it, but certainly not all of it.
Although we see that these programs are at their heart retention tools. And so the goal is to have people, to retain people, and have them be present. So for the majority that we see, the recipients have to be present and employed unless there's some unforeseen circumstance.
Yeah, I would agree with that.
Yeah, I would too. I think that's well said, Liz. Okay, I'm going to move. Okay, wait a minute. We had a couple other questions. So the question was, is median cash on the stock the total value over 3 years or an annualized value? What we survey is the annualized value. What did you get from the stock that year? just for clarification. And then we had another question on, can you clarify the number of years of experience for each role? Senior associate, senior investment professional, senior corporate level executive. I can, but we're not going to do that right. We're not going to do that on this call. We do have job descriptions and level descriptors. Liz will attest to that because she's written about 90% of them with us. And we do have all that. So there is a leveling. And also, of course, when we get our data and we see that there's a comp number for, let's say, a senior investment professional that falls below the minimum that we have for that job, and it's very much lower, we go in and really see if that, not all CVCs are created equal, right? I mean, everyone's shaking their head because it's true. Some are more sophisticated and some not. So that's very much a part of why the J.Thelander data is so strong, because we do all of that leveling. We delve in to really understand, speak to people, understand the roles. And even though you may have one title, it may have to go into the database as a different title because of where it is in the more sort of global holistic market. We have one more question. Hang on. Are you seeing a higher correlation between recruiting a CVC unit leader from outside and faster movement toward competitive compensation structures versus recruiting from inside? I would say yes, because the outside, we get these phone calls to put comp structures together all the time, and someone's coming in from outside or they came from VC. And they absolutely are requiring different protocols, and it's part of the agreement for them coming in. And in order to actually hire this person, it's going to take some adjustment. Liz, your thought? I mean, you see this as well.
Yeah, no, absolutely. And it's our perspective that CVC really has become a professional sport, and that there's a great deal of consistency among what a CVC investor would be doing versus what a VC investor would be doing. I think where you get a little bit of a different aspect is with the CVBD or portfolio development roles, which play much more critical components within the CVC. And so, thinking about to what extent they get included in any of the financial upside programs is a challenge that many are dealing with, particularly if they're rotational.
Right, because they're also having to go with the parent company. But I would argue here also that VCs have become a professional sport versus just what used to be like the good old boy fraternity. It's not like that anymore. There's been so much more transparency on compensation. And I feel like we've all here been able to contribute to that. Just having sort of an honest answer, in addition to Jim is, you can fill us in on, there are many states now where you're required to be able to share compensation and what the ranges are. And in addition to that, people are talking, and it's become a real career track. And it's open to not only, somebody who knows somebody, but it's really been a very heady recruiting market. And because of the advent of all the diversity, equity, and inclusion on the VC side, there are LPs who are requiring that there are more formal protocols. And on the CVC side as well, because of the recruiting market, there's been that diversity, equity, and inclusion everywhere. And I do really see, we've been surveying gender and ethnicity for 20 years. And on the CVC and VC side, which has been, 15 years on the VC side and almost 10 years on the CVC side, we see that women do very well in CVCs, less so on the VC side, just in terms of the level of participation. But the compensation has become definitely more of more competitive. Jim, anything to add on that, or should I move on?
I would just say one quick thing on sort of VC versus CVC. So I think as the CVCs have become more amenable to the VC structure in terms of that autonomy, you've created, I think, more of an opportunity for that VC, executive or senior person to take a look at that CVC, because they're used to that. They're going to want that. That actually is how they're going to achieve, the carried interest in some respects, is making sure that they have that level and element of control. And it seems to us that you're seeing that more and more these days, which is creating that competitive market, which I think is good for the industry.
And even though 70% of CVCs do invest off the balance sheet, it's been our experience that probably over half actually do have some level of investment autonomy and do have VC level financial performance targets. So we're seeing even those that are in an on balance sheet investing model, a number of them do as well. have begun to adopt carried interest programs.
Yeah, let's look at the shadow phantom synthetic carry, since this is a very common lever. So this is how is it calculated? And the highest percentage is, and Jim, feel free to help us navigate these terms, the percentage of return from the portfolio exits after, as you had said, the corporate hurdle rate. So maybe you want to reiterate this. I think it's important to go slow and break it down, because while we do this every day, not everybody understands it, understandably finds this to be a little confusing.
Yeah, of course. So, depending on the type of model you have, the parent company or if it's a syndicate, that the syndicate is investing a sum of dollars into one or a series of investments, likely a series of investments. That money first has to come back. So when we make an investment in company A, if company A is sold 3 years later and there's a 2x return, or let's say they doubled the money, that first tranche of money that went in, that doesn't count towards how you're gonna get your carried interest paid for. You're going to get it on that upside. So it's the return, it's the benefit or the investment that has been made that gets paid first, and then after that, the proceeds are allocated according to whatever the percentage of the carried interest is here.
Yeah, and that's the same way in venture as well. There is a hurdle rate, and then there can be a catch-up fee where it reverts back, so you get your whole amount, but after that hurdle rate is met.
Right, and then the only sort of, well, not the only, but one of the distinctions here is there are, I think it's less common, but there are scenarios where, depending on how the carried interest was calculated on the front end, could be one portfolio exit or multiple portfolio exits, as opposed to the entire fund at its fund conclusion.
And that's more CVC driven, right? That's where there's more flexibility.
Correct. I think that's right. But I think to Liz's point earlier, you're seeing those hurdle rates stretch out longer and longer too. We've talked to a lot of people recently, even about the clawback percentages and kind of so on and so forth, and when those things can happen and not happen. So
we'll talk. I think we have slides on all that too. So it's basically paid in cash, right? How is it paid? And the cash is considered, or this is income, correct, Jim?
Correct.
So that's, I know you're not giving tax advice, but it's income versus some kind of,
potential for better tax treatment in terms of capital gain type of treatment.
Right. Got it. Okay, Liz, this is you. You created this for us, so helped us with this. So I'm going to because there's a lot of information here. How is your synthetic carried interest bonus pool calculated? And every time I go through these, someone on my team texts me and says, go slow and make sure you read it. So we're going to do that because for the benefit of everybody here. So fund-based, Liz, you're up.
Right. Well, fund-based is what Jim was just talking about. So it assumes that the carried interest is paid after the entire allocated fund amount is returned. And and that's actually the most common, and it's even more common in Europe than it is in the US. But it's a long time frame, as we see that the life of the funds are extending to up to 10 years. So this could be a long wait.
Yeah, so, I mean, we see this on all sides, right? Because on the private company side, and I was just reading this in, I think, term sheet the other day, that, somebody's Series A was $100 million. So there are these very large rounds coming in. It is a longer time to liquidity. The IPO market is very lackluster. And so these exits are becoming, especially in IPO, are becoming longer, and there's fewer and far between. So it's impacting this carried interest.
Right, and in some cases, a corporate hurdle rate, which is often the cost of capital for the corporation, will be applied. In other cases, it'll just be straight return on investment. Then we're starting to see a number of firms even doing a combination of fund-based with some mechanism for interim returns. So paying carry on a deal by deal basis.
Right. So that's the combination of fund-based and deal-based. Early exit bonus paid before fund-based pool kicks in. And we see this even on the venture side. And I don't know, Jim, if you're as experienced as, but we've been now surveying on equity distributions just on a one deal base, because it's taking so long for the fund to have a return that people want to see some kind of payout because it's just taking too long.
Right.
Yeah, and the other thing I would say is sometimes, as you all know, right, VC funds and CVC funds will have different cylinders or different silos, and they'll make investments into those silos, and you'll have dedicated professionals to those silos. So there's this concept in theory that, well, wait a second, I should be rewarded or not rewarded based on what my role is and what my job is, as opposed to the entirety of say, the fund or the investment that the company is making or the parent's making in the whole fund. So it as you've said multiple times, there's no one way. There's a ton of different ways to handle these things.
Right. But the deal base is clearly a higher risk to the parent investor, because if the entire portfolio doesn't perform.
Exactly right.
And then that's where the clawback provision piece comes in.
Right. So here's the how to shadow phantom synthetic carry calculated. And we just did this by assets under management to take a peek, right? The less than 250 million, and then the 250 million plus in investment capital under management. So you can see that the less than 250 has a little more flexibility to have percentage of return from the portfolio company exits after the corporate hurdle rate. Jim, what would you see as a normal hurdle rate? I mean, to put you on the spot, checking our,
I mean, in terms of a percentage.
Yeah. I think it's 6-8%, right?
Yeah, I mean, I've seen it as high as 10, but I would say 6 to 8 is a reasonable percentage.
Yeah, I believe that's what our data shows as well, but I've got someone checking on that right now who will let me know.
And this change in fair market value of the portfolio is an interesting one too. And we've actually seen that applied as one of the components of the short-term bonus sometimes, as opposed to necessarily being part of the synthetic carry calculation.
And every once in a while, we'll see, this is a strange scenario, but every once in a while, we'll see if a company is really succeeding and there's a theory that they're going to hold the investment longer. If there's multiple rounds of investments, you'll see sort of payout on that multiple round of investment as opposed to exit.
I just got a text that the 8% is the most popular option, hurdle rate on the venture side. So, we see that pretty consistently. Great. So the next slide to what fund, this is getting pretty granular, what fund expenses are included in the SCI bonus pool calculation. So again, Liz, I know we came up with these questions because it comes up, right?
Right. Yeah, no, this is what gets really messy with the corporates, and what makes it so difficult to compare corporate financial returns to the way that, for example, Cambridge Associates tracks VC financial returns, just because the net calculations are so different. So a lot of times corporates will just say, we will either assign a prorated amount like a 2% and take that out, or we'll ignore expenses entirely and just look at investment performance.
Yeah, Jim, thoughts on that? I know you deal with this.
I agree, and I think it's extremely important for people to understand going in what is going to be allocated to them, how it's calculated, and how and when it can change. CVCs at times, right? Look, they're businesses. They're going to want to allocate overhead. So what is that overhead? Is it really applicable? Are you using that resource? Can it change over time? If the corporate rates change, does that impact your overhead numbers? It's far from a static scenario.
And you can see, though, don't forget, we're a compensation data and consulting firm. All roads lead at the end to this impacts how you get compensated, right? Because this impacts all of your long-term incentive. And again, here is the Howard. I'm just showing you this so that, because it shows why we're all here, because it all factors in, and it does all go to the success of the CVC as well as the compensation, right? So again, this is the set percentage or discretionary, or and how it's determined, and there is flexibility with this. This I'm going to show you just, I think it's important. What is the cash value of the shadow phantom synthetic carry for the most recent year? And you can see that the average for a CVC unit leader is $822,000. So it can be a very significant number. Even the 25th percentile is $200,000. So these are real numbers, and they contribute to compensation in a very meaningful way to know how to set this up. Here's the vesting time for shadow phantom synthetic carried interest. And the 4 years is significantly lower than anything close to the VC side. The VC side, the most common is still the 5 to 6 years, but it's growing. And then here we go. Jim, you talked about this. So why don't you fill us in a little bit? What's a clawback provision?
So, you in a traditional VC model that CVCs have adopted in many cases, you're paid out upon the exit, whatever that exit ends up being. At times, there are scenarios where through audit or other formulas or scenarios where that frankly has been overpaid for whatever reason. And there are provisions in these documents that speak to how does either the corporate parent or in the VC model, the LPs get that money returned. So it's, we say clawback in essence, just as a repayment of those obligations. And that provision can get heavily negotiated from the standpoint of how is it calculated, when can the clawback occur,
Right.
what is their sort of model in terms of being able to challenge the clawback. It's fairly involved process.
Yeah, we did have a question I do want to clarify that asked to be clear, the cash bonus referenced earlier is separate from the payout from the shadow and the synthetic carried interest. And yes, it does. We don't add that in, in our data we're presenting here. We obviously can do that as we consult, but it is a separate number that we're showing here. So it's in addition to the base pay and cash bonus, which is the annual, because this takes longer, right? These other payouts are not always on an annual basis. There is typically a cap on the amount that can be paid out, because I think, as we well know, you cannot have the CVC people making more money than the folks of the proxy information or your 16B executives. Jim, you're smiling with that because we know it's all true, right?
Yeah, and it can be dangerous too. I mean, that would be a really bad scenario for a public company to have to report something like that. So they're very cognizant of those issues.
Right.
And sometimes it's an annual.
Here we go.
Sometimes it's an annual number, and sometimes it's actually benchmarked against key individuals or key roles.
Right. So here it's calculated, right? Defined cash limit or not to exceed a total compensation for a specific individual. Okay, I'm going to shut the screen down for a second and then see. I mean, we've got a few other topics that we can go through. It's 11:53, so I want to be sensitive to time. I guess, let's see, we can talk about carried interest, or Liz, I'm going to let you decide what you think is most important, or should we look at the CVBD roles?
We could do that. We could look at, I think we had some drill downs on what were the different capabilities that were encompassed within.
Yeah, I mean, this is such a role of growing, and I think the carried interest is, so less relevant to firms, but just so you know that we have that information. So here is the CVBD positions. So this is, does your CVC unit have a dedicated CV business development team members? And the first of all, just the sample size that answered this, but 57% say no, 43% say yes. And maybe you want to talk about, what the CVBD portfolio development team member does and what their role is. You can see that this is has increased a little bit from gone up and then gone down, but the sample sizes have stayed pretty consistent about the dedicated person and what this person is doing.
Yeah, I think from the very beginning, typically often the investment team will be double-hatted and play the CVBD role as well as the investment role, particularly if they're coming from the outside and need to get to know the organization. But once the portfolio sort of starts to get beyond 7 to 10 companies, then often it does require, different skill sets and different types of people. And you want the investment professionals focused on doing deals, but the capabilities that are associated with CVBD would often or particularly relate to what the charter of the organization is. Like, for example, if you have an organization which is really focused on internal adoption or really landing the portfolio company within the parent, then maybe you would have people that would focus on some of the more operational capabilities and the ability to project management.
But it can be, I think the point is
right.
that these
right.
people, they typically come from the parent company because they have the parent company expertise and they can liaison between the parent company, but they also have a very important role with the portfolio companies as well as internally to the CVC. And Jim, you're shaking your head with that. I want to see.
Though, if you do have ones that are focused beyond the scope of the existing business, then often these roles may be more like strategic advisory consulting roles. So in that case, you would often have people coming from the outside who would, be able to play a guiding role.
Yeah, I think a lot of it has to do with what the strategic goal of the CVC is, right? If it's core to the parent company, you almost always see then somebody from the parent being in that BD role. Whereas if it's, maybe outside of the core, meant to do something that's not directly to the core of the parent, oftentimes external sources are, I wouldn't say a better, but they provide a different opportunity for people to think about things that the parent hasn't thought about.
And then, of course, there are the venture development kinds of capabilities that would be analogous to a VP platform team.
Yeah. So here I'm going to look at their cash, and then we're going to wind up just to be sensitive to everybody's time. We could keep going probably for a good another hour with all the data that we have. But you can see that this is the this is the portfolio development professional. So this is not we have different levels here. But you can see that the comp now, the median has gone up to now $200,000 because it was steady, and now has grown, because this role is becoming very important and has taken on a separate career track.
Yeah, we actually run a course on it now called Landing the Value of Corporate Venturing.
Oh, interesting. Tell us with this.
Yeah, no, it's our flagship Institute Professional Development Program, where we have corporations send pods of people that may include an investment professional, a BD professional, and even a representative of the parent, that spend 3 months working together on how they optimize the value of the program and of the interaction. And it's not just the investment team that's a professional sport. We've seen over the past 5 years that this portfolio development and BD role is also a professional career.
And let's see that. And let me tell you, the VCs are doing all of that now because they've learned from the CVCs how important that is. You can't just throw money at it. Also, at the portfolio companies, the help that you give is very integral to the success of the portfolio company as well. Let me tell you the things that we didn't cover here, just so you know what else is part of this whole ecosystem, is the diversity, equity, inclusion. We have all the information on salary increases, on bonuses, on hiring. And those are the main sections that we didn't hit because we ran out of time. I want to thank you all. You've been a great group. Everyone stayed on the whole time, and Jim and Liz, obviously your expertise speaks for itself, and how basically you just rolled off every topic here. And if we're going to send out a thank you, we'll also send out a recording and a link to participate in the survey. And again, you get access to a subset of the results for no charge, called the Silver subscription. And if you have any specific questions, feel free to reach out with us. We'll make sure you have the contact information for both Jim and Liz as well. So thanks to everybody and my team for coordinating this, and we'll stay in touch. Any other thoughts, Jim or Liz?
Well, thank you, Jody. Always a pleasure.
No, likewise. Well said. Thanks very much.
Great. Thank you.